Speculation often ignores valuation. Rising prices create justification. High expectations replace margin of safety. Graham believed that overpaying converts investment into speculation. Regardless of business quality, intrinsic value, in Graham's view, was not a precise number, it was a range. Estimation involved judgment and conservatism. He encouraged investors to assume they might be wrong and to protect against that possibility. This protection came from buying below intrinsic value. Fundamental analysis also required understanding industry conditions, competition, and economic context. Graham did not expect investors to predict the future, but he expected them to recognize structural risks. Speculation often relies on optimism about the future. Investment acknowledges uncertainty. Graham believed that uncertainty was unavoidable, but vulnerability was optional. Another critical element of fundamental investing is time horizon. Businesses evolve slowly. Their value is realized over years, not weeks. Investors must align their expectations with this reality. Speculators operate on compressed timelines. They expect immediate validation. When it does not arrive, they abandon positions. Investment requires endurance. Graham also emphasized diversification as a fundamental principle. No analysis was perfect. Diversification reduced the impact of errors. It protected against unforeseen events. Speculators often concentrate positions, believing conviction increases return. Graham believed concentration increased risk. Investment accepted modest returns in exchange for survivability. Another aspect of fundamentals is cash flow. Profits must be converted into cash. Accounting earnings without cash support were suspect. Graham examined cash generation carefully. Speculation often ignores cash flow entirely. Graham also warned against confusing innovation with value. New industries generate excitement. Narratives flourish. Prices rise. Fundamental data is often limited. Investment requires evidence. Speculation thrives on possibility. Investment relies on probability. Graham believed that probability favored fundamentals over narratives. Fundamental investing also required independence. Investors had to think for themselves. They could not rely on market opinion. They had to develop their own judgments. This independence was uncomfortable. It often meant being early or alone. Speculators draw confidence from crowds. Investors draw confidence from analysis. Graham also understood that fundamental analysis did not guarantee success. Markets could remain irrational longer than expected. Prices could diverge from value for extended periods. This reality reinforced the importance of patience. Fundamentals do not assert themselves immediately. They assert themselves eventually. Another key difference between speculation and investment is reaction to new information. Speculators react instantly. Investors evaluate carefully. Graham believed that most news was irrelevant to long-term value. Short-term events often dominated headlines but faded quickly. Investment focused on what endured. Fundamental analysis also encouraged long-term relationships with holdings. Investors became owners, not traders. They monitored businesses periodically, rather than constantly. This reduced emotional volatility. Speculators lived in constant engagement. Investors lived with periodic review. Graham believed that constant attention increased error. Fundamental investing also reduced reliance on market timing. Investors did not need to buy at bottoms or sell at tops. They needed reasonable prices and time. Speculation depended on timing. Investment depended on value. Graham believed that timing was unreliable and unnecessary. Another important element of fundamentals is margin of safety, which Graham considered the cornerstone of investment. Margin of safety allowed room for error. It acknowledged uncertainty. Speculation eliminated margin of safety in pursuit of speed. Investment preserved it in pursuit of survival. Graham believed that the margin of safety principle applied universally. Whether buying stocks, bonds, or other securities, investors should insist on protection. Protection allowed patience. Fundamental investing also fostered humility. Investors recognized that they could not predict everything. They focused on what could be reasonably known. Speculators believed they could anticipate outcomes. Investors accepted limits. This acceptance was a strength. Graham also emphasized that fundamentals provided grounding during volatility. When prices fell, investors could return to analysis. They could ask whether value had changed or merely price. Speculators had no such anchored price movement dictated emotion. Investment anchored decisions to reality. Another advantage of fundamental investing is that it aligns with compounding. Stable businesses generate earnings over time. Reinvestment builds value. Speculation interrupts compounding through frequent trading. Graham believed that time multiplied the benefits of fundamentals. As businesses grew and earnings accumulated, value increased, prices eventually followed. This process required patience. Fundamental investing also reduced the need for constant vigilance. Investors could focus on life rather than markets. Their strategy did not depend on minute-by-minute decisions. Speculation demanded constant attention. Graham believed that investing should support life, not dominate it. Car speculation destroys discipline. Benjamin Graham believed that discipline was the true foundation of successful investing. Without discipline, analysis collapses. Without discipline, patience disappears. And without discipline, even the soundest strategy becomes ineffective. Speculation, in Graham's view, was the single greatest enemy of discipline. Speculation does not destroy discipline suddenly. It erodes it gradually. At first, speculative behavior appears harmless. An investor reacts to a news event. They adjust a position. They take a short-term opportunity. Each action feels reasonable. Each decision seems justified. Over time, however, the nature of decision-making changes. The investor no longer follows a plan. They follow the market. Speculation shifts authority away from the investor's framework and hands it to price movement. Decisions are no longer guided by valuation or fundamentals, but by emotion, urgency, and comparison. This shift is subtle, but its consequences are profound. Discipline requires consistency. Speculation introduces variability. Every speculative decision creates a new rule. One trade is based on momentum, another is based on news, another is based on sentiment. Over time, there is no coherent strategy, only reaction. Graham believed that a strategy that changes constantly is not a strategy at all. Speculation also weakens conviction. Because speculative positions are rarely grounded in deep analysis, they cannot withstand pressure. When prices move against them, doubt arises quickly. There is no analytical anchor to return to. Investment positions, by contrast, are supported by understanding. When volatility occurs, investors can revisit fundamentals. They can ask whether value has changed. This process reinforces discipline. Speculators have no such process. Another way speculation destroys discipline is through emotional trading. Short-term price movement triggers fear and excitement. These emotions demand action. The investor responds, believing they are being prudent. In reality, they are being reactive. Fear leads to premature selling. Excitement leads to overpaying. Both decisions undermine long-term outcomes. Graham observed that emotional trading rarely feels emotional in the moment. It feels logical. Investors tell themselves they are managing risk or capturing opportunity. Only in hindsight does emotion become obvious. Speculation also encourages trend chasing. Rising prices attract attention. Media coverage intensifies. Success stories circulate. Investors feel compelled to participate. Trend chasing shortens time horizons. It shifts focus from value to popularity. Investors buy not because assets are undervalued, but because others are buying. Graham believed this behavior was particularly dangerous because it reversed the logic of investment. Instead of buying when prices were favorable, investors bought when prices were elevated. Discipline requires resisting trends. Speculation encourages following them. Another destructive effect of speculation is overtrading. Frequent buying and selling creates the illusion of control, but it increases costs, taxes, and error frequency. Each trade introduces risk. Graham believed that the more decisions an investor makes, the more opportunities they create to make mistakes. Investment reduces decision frequency. Speculation increases it. Over time, overtrading exhausts investors mentally and emotionally. Fatigue sets in, judgment deteriorates, discipline weakens further. Speculation also distorts feedback. Short-term results are noisy. Gains may occur by chance. Losses may occur despite correct reasoning. Investors misinterpret these outcomes. They abandon sound approaches after temporary losses and reinforce flawed ones after lucky gains. Graham believed that short-term feedback teaches the wrong lessons. Discipline requires long-term evaluation. Speculation replaces evaluation with reaction. Another way speculation destroys discipline is by encouraging rationalization. When speculative decisions fail, investors justify them. They blame external factors. They reinterpret assumptions. They adjust narratives. This rationalization prevents learning. Investment encourages accountability. Decisions are reviewed objectively. Errors are acknowledged. Process is refined. Speculation avoids accountability by shifting focus constantly. Speculation also undermines discipline by increasing comparison. Investors measure performance against others. They feel pressure to keep up. This pressure shortens horizons and increases risk tolerance. Graham believed that comparison was one of the most corrosive forces in investing. Investment focuses on objectives. Speculation focuses on relative performance. Another damaging effect of speculation is loss of patience. When investors become accustomed to quick results, waiting feels intolerable. Even sound investments are abandoned because progress is slow. This impatience prevents compounding. Graham believed that impatience converts good decisions into bad outcomes. Speculation also weakens discipline by blurring boundaries. Investors begin to mix speculative behavior into investment portfolios. They justify it as flexibility. Over time, speculation dominates. Clear separation disappears. Graham insisted on separating investment from speculation precisely because discipline depended on it. Speculation also changes how investors perceive risk. Gains reduce fear, losses increase urgency. Risk tolerance fluctuates wildly. Investment maintains stable risk parameters. Speculation makes risk situational. This instability undermines discipline. Another critical point Graham made was that speculation creates dependence on market validation. Investors seek confirmation from price movement. When prices rise, they feel correct. When prices fall, they feel wrong. This dependence erodes independent thinking. Investment requires independence. Decisions must be justified without immediate validation. Speculation also erodes discipline by encouraging short memory. Past mistakes are forgotten. Patterns repeat. Lessons are not internalized. Investment encourages long memory. History informs decisions. Graham believed that investors who speculated repeatedly learned less over time, not more. Speculation also amplifies regret. Missed opportunities feel painful. Losses feel personal. This regret drives impulsive behavior. Investment reframes regret as cost of discipline. Missed opportunities are accepted. Losses are evaluated calmly. Another destructive consequence of speculation is strategy drift. Investors abandon principles gradually. What begins as occasional speculation becomes habitual. Eventually, discipline disappears entirely. Graham believed that discipline must be protected actively, not assumed. Investment discipline requires rules, structure, and restraint. Speculation undermines all three over long periods. The cumulative effect of speculation is devastating. Small mistakes compound. Emotional decisions accumulate. Returns suffer. Speculation does not usually destroy portfolios in one moment. It destroys them slowly, quietly, and predictably. Investment, by contrast, builds resilience. Discipline strengthens over time. Confidence grows from experience rather than excitement. Graham believed that investors who avoided speculation preserved not only capital, but clarity. Clarity is essential. Realistic stories of speculative failure. Benjamin Graham believed that nothing reveals the danger of speculation more clearly than lived experience. Statistics can be ignored, theory can be debated, but stories, especially familiar ones, are difficult to dismiss. Over decades, Graham observed the same patterns repeating again and again across different markets, generations, and economic environments. The details changed. The mistakes did not. The first story is one Graham saw countless times. An investor enters the market cautiously. They read books. They listen to respected voices. They believe they understand the difference between speculation and investment. At first, their behavior reflects this understanding. They buy established companies. They avoid excessive risk. They hold positions patiently. Then the market changes. Prices begin to rise quickly in certain areas. New opportunities dominate conversation. Friends talk about fast gains. Media coverage intensifies, the investor begins to feel left behind. They tell themselves they will participate just a little. They buy a popular stock not because it is undervalued, but because it is rising. They justify the decision by pointing to strong narratives and optimistic forecasts. They tell themselves they are still investing. At first, the decision works. The stock rises further, confidence grows, the investor feels validated. They believe they have adapted intelligently. They increase exposure. Then conditions shift, the narrative weakens, prices stall. Volatility increases. The investor becomes uneasy. They check prices more frequently. They search for reassurance. Losses begin. They tell themselves they will wait. But waiting feels different now. This position was never grounded in analysis. It was grounded in momentum. There is no anchor to return to. They sell. The loss is manageable. But the damage is deeper than the number suggests. The investors' discipline has been compromised. They have learned the wrong lesson. Graham observed that speculative losses often teach investors to speculate more carefully, not to stop speculating. Another common story involves the investor who believes they can get out in time. This investor is intelligent, analytical, and confident. They understand risk in theory. They believe that speculation is dangerous for others but manageable for them. They enter speculative positions with exit plans, stop-loss orders, mental thresholds, timing strategies. For a while, it works. They exit small losses quickly. They capture gains. They feel skilled. Each successful exit reinforces belief in control. Then the market moves faster than expected. A sudden event occurs. Prices gap down. Liquidity disappears. Orders are filled far below expectations. Losses are larger than planned. The investor is shocked. They realize that their exit strategy depended on conditions that no longer exist. Control was an illusion. Graham saw this repeatedly. He believed that strategies dependent on perfect execution fail precisely when they are needed most. Another story involves the investor who speculates out of boredom. This investor has built a solid portfolio. Returns are steady but unspectacular. Markets are calm. Nothing exciting is happening. They begin to feel restless. They read about new opportunities, emerging sectors, innovative technologies. The potential feels enormous. They allocate a small portion of their portfolio to speculation, believing it will add excitement without meaningful risk. At first, nothing happens. Then prices move. Gains appear. Excitement returns. Encouraged, they allocate more slowly. The speculative portion grows. The original portfolio feels dull by comparison. Attention shifts. Discipline erodes. Eventually, a downturn occurs. Speculative positions collapse. Losses are larger than expected. The investor realizes too late that boredom led them to abandon discipline. Graham believed that boredom was one of the most underestimated risks in investing. Another story Graham encountered frequently involved the investor who confused intelligence with immunity. This investor was well educated. They understood financial concepts. They believed that knowledge protected them from common mistakes. They speculated confidently, believing they could recognize danger early. They interpreted volatility as opportunity. They dismissed caution as fear. When losses occurred, they doubled down, believing they were correct and the market was wrong. They increased exposure rather than reducing it. Eventually, losses became overwhelming. Graham believed that intelligence without discipline often accelerates failure. Another painful story involved investors who speculated during crises. Markets fell sharply. Fear dominated. Prices collapsed. Speculators believed they were buying bargains. They assumed recovery would be swift. They ignored balance sheets. They ignored long-term viability. They focused on price declines alone. Some positions recovered. Many did not. The investor realized too late that low price does not equal value. Without analysis, bargain hunting becomes speculation. Graham warned repeatedly against this mistake. There are also stories of investors who speculated based on expert opinion. They followed respected voices, analysts, commentators, and professionals, offered confident forecasts. The investor trusted authority. They entered positions without independent analysis. When predictions failed, responsibility was diffused. The investor blamed experts, markets, or bad luck. Graham believed that outsourcing judgment is a form of speculation. Investment requires ownership of decisions. Another recurring story involved investors who speculated during bull markets and invested during bear markets without realizing it. During rising markets, they chased trends. During falling markets, they became cautious. This reversal of logic produced poor outcomes. Graham believed that speculation often appears rational during bull markets and disastrous during bear markets, while investment appears slow during bull markets and wise during bear markets. Timing these shifts correctly is extremely difficult. Speculation also led many investors to abandon diversification. Convinced they had found exceptional opportunities, they concentrated positions. They believed conviction reduced risk. When those positions failed, losses were severe. Graham believed that concentration magnifies errors. Another subtle story involved investors who speculated emotionally while believing they were rational. They reacted to fear and excitement, but justified decisions intellectually. They created narratives to support impulses. Graham believed that rationalization was speculation's greatest defense mechanism. It prevented self-awareness. One of the most tragic speculative failures Graham observed involved investors who nearly succeeded. They speculated successfully for years, gains accumulated. Confidence grew, they believed they had mastered the market. Then, one cycle reversed violently, losses erased years of progress. Recovery was impossible. Graham believed that speculation often fails not because it is always wrong, but because it must always be right. Investment does not require perfection, speculation does. These stories share common elements: short time horizons, reliance on prediction, emotional reaction, lack of structural protection. Time was not respected. Graham did not tell these stories to discourage participation in markets. He told them to encourage clarity. Speculation is seductive. It offers excitement, validation, and the illusion of control, but its costs are cumulative and unforgiving. Investment, by contrast, appears slow and unspectacular, yet it offers survivability. Stories. True investor Benjamin Graham often noted that the most successful investors rarely appear remarkable while their success is unfolding. Their actions do not attract attention. Their decisions are not dramatic. They do not generate headlines, yet over long periods, their results speak clearly. These investors succeed not because they are brilliant, but because they are disciplined. 1. Such story begins with an investor who entered the market with modest expectations. They did not seek extraordinary returns. They sought stability, protection, and gradual growth. They studied businesses carefully. They focused on balance sheets, earnings history, and valuation. They avoided excitement. When markets surged, they did not chase rising prices. They accepted underperformance. They reminded themselves that overpaying destroyed safety. When markets declined, they reassessed fundamentals. They confirmed that businesses remained viable. They held views past. The investor's portfolio grew. Slowly, dividends accumulated, earnings increased. There were periods of stagnation. There were drawdowns. Through it all, the investor remained consistent. Eventually, the results became visible. Capital had grown meaningfully. Volatility had been absorbed. Losses had been temporary. Graham believed that this type of success was not accidental, it was structural. Another story involves an investor who lived through several market cycles. They experienced booms and busts. They observed how enthusiasm turned to fear and how fear eventually faded. Early in their journey, they made mistakes. They speculated occasionally. They chased trends. They learned painfully. Over time, they simplified. They reduced trading. They narrowed focus to fundamentals. They stopped trying to predict. They accepted uncertainty. Each cycle reinforced discipline. By the time later downturns arrived, this investor responded differently. They were not shocked. They were prepared. They did not panic. Their portfolio endured. Graham believed that experience rewarded those who reflected rather than reacted. Another quiet success story involves investors who remained invested during prolonged periods of pessimism. During economic downturns, headlines were grim. Forecasts were negative. Confidence was scarce. Many investors exited entirely. These investors did not. They reviewed balance sheets. They examined earning power. They assessed survival. They held. Recovery did not arrive quickly. It came gradually. Earnings improved. Sentiment shifted. Prices rose. Those who remained benefited disproportionately. Graham believed that the market rewards those who endure pessimism without surrender. There are also stories of investors who succeeded simply by doing less. They built diversified portfolios. They avoided leverage. They resisted frequent changes. They ignored noise. They did not attempt to optimize constantly. They aimed for durability. Over decades, their portfolios compounded steadily. Errors were absorbed, gains accumulated. Their success was not visible year to year. It became obvious only over long periods. Graham valued this invisibility. Another story involves investors who resisted social pressure during speculative booms. They were criticized. They were told they were missing opportunities. They were labeled conservative. They accepted this criticism calmly. They understood that popularity did not equal correctness. They trusted analysis over opinion. When booms ended, these investors were intact. Their capital was preserved. They were positioned to act. Graham believed that independence was a prerequisite for investment success. There are also stories of investors who maintained discipline during stagnation. Markets do not always rise. There are long periods where prices move sideways. These periods test patience more than volatility. Many investors abandon strategies during stagnation. True investors remain. They understand that businesses continue operating regardless of stock prices. Earnings accumulate. Dividends are paid. Eventually, stagnation ends. Those who waited benefit. Graham believed that stagnation rewards patience quietly and punishes impatience severely. Another important category of success involves investors who separated speculation from investment honestly. They acknowledged that speculation existed. They limited it consciously. They did not allow it to contaminate long-term capital. Investment capital remained protected. This separation preserved discipline. Graham believed that honesty about behavior was essential. There are also stories of investors who benefited from reinvestment over time. Dividends reinvested during downturns purchased additional shares at lower prices. Over time, these additional shares amplified returns. This process required patience. Speculators interrupted reinvestment. Investors allowed it to continue. Time magnified the difference. Another story involves investors who redefined success. They did not seek to outperform markets every year. They sought to meet long-term goals reliably. This mindset reduced stress. Reduced stress improved judgment. Improved judgment reinforced discipline. Time rewarded this cycle. Graham believed that emotional stability was one of the most valuable assets an investor could possess. True investors also learned to accept missed opportunities. They did not regret every rising stock they did not own. They understood that opportunities were infinite, but capital was limited. They focused on safety rather than participation. This acceptance preserved clarity. Graham believed that avoiding regret was not about capturing every gain, but about avoiding destructive losses. Another quiet success story involves investors who ignored forecasts. They listened selectively. They acknowledged uncertainty. They did not anchor decisions to predictions. Instead, they built resilient portfolios. Time validated this approach. Graham believed that robust strategies outperform precise forecasts. There are also stories of investors who developed patience through adversity. Early losses taught humility. Mistakes reinforced caution. Experience shaped discipline. These investors emerged stronger. Graham believed that markets are harsh teachers, but effective ones. True investors also developed perspective. They understood that markets were part of life, not life itself. Investing supported their goals rather than dominating their attention. This balance reduced emotional interference. Graham believed that investing should enhance well-being, not undermine it. The common thread in all these success stories is simple. These investors respected time. They did not demand immediate validation. They did not chase excitement. They did not confuse speculation with investment. They allowed value to emerge. Risk, speculation vs. investment. Benjamin Graham did not think about risk the way most market participants do. To him, risk was not volatility. It was not daily price movement. It was not uncertainty. Risk, in its most serious and meaningful form, was the permanent loss of capital. This definition changes everything. Speculators often equate risk with short-term price fluctuation. When prices move sharply, they believe risk has increased. When prices are calm, they believe risk has decreased. Graham believed this perspective was deeply flawed. Volatility is visible. Permanent loss is not until it occurs, speculation increases. The probability of permanent loss, because it depends on conditions that cannot be controlled, timing, sentiment, liquidity, and emotion all play central roles. When any of these factors turn unfavorable, speculative positions become vulnerable. Investment, by contrast, is designed to reduce the probability of permanent loss. It does not eliminate risk, but it manages it structurally. This is where Graham's most important concept emerges: margin of safety. The margin of safety is the difference between price and value. It is the buffer that protects investors from error, uncertainty, and unexpected events. Graham believed that no analysis was perfect and that all forecasts were uncertain. The margin of safety acknowledged this reality. Speculation operates without margin of safety. It assumes correctness. It assumes timing. It assumes favorable outcomes. Investment assumes fallibility. This assumption is not pessimism, it is realism. Graham believed that the margin of safety was not optional, it was essential. Without it, investing became speculation regardless of intent. Another critical distinction between speculation and investment lies in risk concentration. Speculators often concentrate positions. They believe conviction increases return. They focus capital on ideas they believe will perform quickly. Graham believed this behavior magnified error. When a concentrated speculative position fails, recovery is difficult or impossible. Investment embraces diversification. Diversification does not eliminate risk, but it reduces the impact of individual mistakes. It allows time to work. Speculation often assumes that risk can be managed through speed. Investors believe they can exit positions quickly if conditions change. Graham observed that this assumption frequently failed during periods of stress. Liquidity disappears when it is needed most. Investment does not depend on liquidity for protection. It depends on valuation and balance sheet strength. Another important risk distinction involves leverage. Speculation often relies on borrowed capital. Leverage magnifies gains and losses. It accelerates outcomes. Graham warns strongly against leverage because it removes time as a defense. Leveraged positions cannot wait. They are forced to act under pressure. Investment preserves time. Speculation sacrifices it. Time is a form of capital. Graham also emphasized that risk increases when investors rely on optimism rather than analysis. Optimism encourages overpayment. Overpayment reduces margin of safety. Reduced margin of safety increases vulnerability. Speculation thrives on optimism. Investment restrains it. Another dimension of risk Graham highlighted was behavioral risk. Emotional decisions amplify loss. Fear causes panic selling. Excitement causes overbuying. Speculation exposes investors to continuous emotional stress. Investment reduces exposure by limiting decision frequency and extending time horizons. Behavioral risk is often more dangerous than financial risk. Graham believed that investors must manage themselves as carefully as they manage portfolios. Speculation also increases systemic risk exposure. When many participants speculate similarly, correlations increase. When conditions change, losses become widespread. Investment diversification reduces this exposure. Another subtle risk difference lies in information overload. Speculators consume constant news. Each update influences decisions. This overload creates confusion. Investment filters information. Only material changes matter. Graham believed that excess information increases error. Risk also increases when investors chase returns rather than manage downside. Speculation prioritizes upside. Investment prioritizes survival. Survival is the prerequisite for compounding. Graham believed that investors should always ask, "What happens if I am wrong?" Speculators rarely ask this question seriously. Investment begins with it. Another critical risk difference involves time horizon mismatch. Speculators often invest short-term capital in long-term assets or vice versa. This mismatch forces action under unfavorable conditions. Investment aligns time horizon with asset characteristics. Graham believed that mismatched horizons created unnecessary risk. Speculation also distorts perception of success. Short-term gains hide long-term vulnerability. Investors believe they are succeeding until failure becomes unavoidable. Investment measures success over full cycles. Time reveals risk truthfully. Graham also emphasized that risk cannot be eliminated, only managed. Speculation attempts to avoid risk through prediction. Investment manages risk through structure. Prediction fails. Structure endures. Another important aspect of risk is psychological endurance. Speculative strategies often require constant correctness. This requirement creates stress. Stress increases error. Investment tolerates error. Margin of safety absorbs. Graham believed that a strategy that cannot tolerate error is a dangerous strategy. Speculation also increases risk by encouraging frequent reassessment. Constant changes create instability. Investors lose coherence. Investment maintains consistency. Risk is also increased by social pressure. Speculative behavior spreads quickly. Crowds amplify mistakes. Investment independence reduces this risk. Graham believed that crowds create danger, not safety. The margin of safety also provides emotional protection. It allows investors to hold through volatility. It reduces fear. It strengthens conviction. Speculation offers no such protection. Another critical risk difference is recovery potential. Speculative losses often occur suddenly and severely. Recovery is difficult. Investment losses are often gradual and reversible. Time heals investment losses. It rarely heals speculative ones. Graham believed that avoiding ruin mattered more than achieving brilliance. Many investors seek extraordinary returns. Graham sought acceptable returns with high survivability. Speculation chases upside. Investment manages downside. This difference defines everything. As we move into the final part of this master script, we will bring all these ideas together and examine the mindset of the investor versus the speculator, how they think, behave, and experience markets differently, and why Graham's warning remains as relevant today as ever. The investor's mindset vs. the speculator's mindset. Benjamin Graham's final warning. Benjamin Graham believed that the ultimate difference between speculation and investment was not found in techniques, tools, or intelligence. It was found in mindset. Two people could look at the same market, the same stock, the same information, and yet behave entirely differently. One would speculate, the other would invest. This difference determined outcomes. The speculator approaches the market as a place of action. Movement is interpreted as opportunity. Change is interpreted as urgency. The speculator feels compelled to respond. Price becomes the central signal. Emotion follows quickly. The investor approaches the market as a place of evaluation. Movement is observed, not obeyed. Change is examined, not chased. The investor feels no urgency to act without justification. Value, not price, is the anchor. The speculator asks, what will the market do next? The investor asks, what is this worth? This single difference reshapes every decision. The speculator depends on prediction. The investor depends on preparation. Prediction promises control, but delivers fragility. Preparation accepts uncertainty, but builds resilience. Graham believed that markets reward resilience far more reliably than prediction. The speculator lives in short time frames, days, weeks, sometimes hours. Success must appear quickly. When it does not, doubt sets in, action follows. But investor lives in long time frames, years, sometimes decades. Success is allowed to unfold gradually. Delay does not threaten conviction. Time is the investor's ally and the speculator's enemy. The speculator experiences the market emotionally. Gains bring excitement, losses bring fear. Every fluctuation feels personal. Confidence rises and falls with price. The investor experiences the market analytically. Gains are evaluated cautiously. Losses are examined rationally. Prices inform, but do not define. Graham believed that emotional involvement was the root of most investment failures. The speculator seeks excitement. The investor seeks durability. Speculation offers stimulation, stories, and validation. Investment offers boredom, patience, and delayed reward. Most people choose excitement because it feels rewarding in the moment. Graham warned that what feels good in the short term often feels painful in the long term. And what feels painful in the short term often proves rewarding in the long term. The speculator measures success by recent performance. The investor measures success by survival and consistency. Speculators often celebrate short-term wins without asking whether the strategy that produced them can endure. Investors ask whether a strategy can survive adverse conditions before celebrating. Results. Survival comes first. The speculator reacts to volatility. The investor anticipates it. Volatility shocks speculators because it threatens their sense of control. Investors expect volatility and prepare for it. Preparation transforms volatility from danger into test. The speculator sees risk as price movement. The investor sees risk as permanent loss. This distinction is critical. Price movement is temporary, permanent loss is final. Graham believed that confusing the two caused more damage than any market crash. The speculator believes they can exit in time. The investor assumes they might not be able to and plans accordingly. Speculation relies on favorable conditions. Investment is designed to function even when conditions are unfavorable. The speculator often increases risk after success. The investor increases caution. Success blinds speculators. Experience humbles investors. The speculator believes intelligence protects them. The investor believes structure protects them. Structure includes diversification, margin of safety, conservative assumptions, and long time horizons. These elements do not depend on mood, confidence, or prediction. They endure. The speculator often believes they are learning because they are active. The investor learns because they observe patterns over time. Activity does not equal learning. Reflection does. The speculator is constantly engaged with the market. The investor is selectively engaged. Graham believed that constant engagement increases error, while selective engagement improves judgment. The speculator often confuses confidence with competence. The investor remains skeptical of confidence. Markets reward humility. The speculator seeks to win. The investor seeks to avoid losing. Winning feels heroic. Avoiding loss feels unremarkable. Yet over time, avoiding loss creates the conditions for compounding. Compounding does not forgive speculation. It rewards patience. The speculator is focused on opportunity. The investor is focused on probability. Speculation thrives on possibility. Investment is grounded in likelihood. The speculator depends on stories. The investor depends on numbers. Stories inspire action. Numbers impose restraint. The speculator follows crowds. The investor tolerates solitude. Independence is uncomfortable, but essential. Graham believed that the market punishes those who seek comfort and rewards those who accept discomfort. Speculation feels comfortable during booms. Investment feels uncomfortable because it resists participation. When conditions reverse, the discomfort shifts. Time exposes truth. The speculator often believes that avoiding action is risk. The investor understands that unnecessary action is risk. The speculator trades frequently. The investor acts rarely. Frequency increases error. Selectivity increases impact. The speculator believes success is about being right. The investor believes success is about being disciplined. Discipline endures when brilliance fades. Graham did not condemn speculation entirely. He condemned confusion. He warned investors repeatedly, do not speculate under the belief that you are investing. This belief is the most dangerous of all. Speculation, when acknowledged honestly, can be limited and controlled. Investment, when practiced faithfully, can build lasting security. The tragedy Graham observed was that most investors wanted the rewards of investing but behaved like speculators. The solution was clarity. Know what you are doing. Know why you are doing it. Know what protects you if you are wrong. If those questions cannot be answered clearly, the operation is speculative. Graham's philosophy was never about beating the market. It was about surviving it intelligently. Markets will always fluctuate. Opinions will always change. Prices will always move. But value, over time, asserts itself. The investor aligns with this reality. The speculator fights it. Time decides who prevails. Speculation promises excitement. Investment demands discipline. Speculation relies on prediction. Investment relies on preparation. Speculation seeks quick validation. Investment waits for reality to assert itself. Benjamin Graham's warning is simple and timeless. If an operation does not protect your capital and offer a reasonable return through analysis, it is not investing. On this channel, we focus on clarity over noise, discipline over excitement, and long-term thinking over short-term reaction, because in the end, time rewards the patient, punishes the reckless, and exposes the difference between speculation and intelligent investing. Thank you for listening. Stay disciplined, stay rational, and let time work in your favor.